What is a conventional loan? If you've been looking into mortgages at all, trying to get pre-approved, you have no doubt heard lenders refer to a conventional loan as opposed to maybe FHA or VA. In this video, we're going to talk about conventional loans, why you might want to qualify for them, what their positives are, and everything you need to know about them. I'm Peter Lindquist with the Lindquist team at Guaranteed Rate. I've been writing conventional loans for over 30 years. In today's world, we're seeing a lot of changes in conventional financing, so we definitely want to get you prepared for it. If you've got any questions or comments, be sure to leave them in the comments below. I've left all of my contact info in the description. And if you like this video, please consider supporting our channel by subscribing to it, liking this video, sharing, that sort of thing. I'd appreciate it. Okay, so what is a conventional loan? Simply put, it's a home loan that meets the standards for Fannie Mae and Freddie Mac. These are these two large government-sponsored enterprises that offer low-rate, fixed-rate mortgages. Conforming loans means that the loan is under a certain loan amount. So I'm going to talk about the Twin Cities area market, and that is $726,200 for a single family loan. So that's the maximum loan size. The actual purchase price can be much higher. It can be $1 million, but the maximum loan currently is $726,200. That amount actually varies based on duplex or triplex. Those actually are higher. Conventional loans will finance 1 to 4 families. So single family, duplex, triplex, fourplex. Anything above that is not going to be eligible for a conventional loan. In general, conventional loans are the least expensive of all types of mortgages in most cases. They are harder to qualify for. Okay, so generally speaking, it's better credit, it's lower debt to income ratios. If you've had major credit events like a bankruptcy, it needs to be a longer time ago. In that case, it's 4 years, where FHA and VA is as little as 2 years. So conventional loans tend to be more difficult to qualify for, but they're worth it in most cases. Now, one of the big reasons why realtors in particular will encourage you to try to get a conventional loan is that when you make your offer to a seller, sellers will prefer conventional financing. And there's really kind of two reasons behind that. One is conventional financing tends to be less picky about the quality of the home than does, say, an FHA loan. That's one reason. Second reason is sellers tend to perceive a conventional buyer as a stronger buyer. So with FHA, you can be a borrower with a much lower credit score, and they perceive, for right or wrong, that that loan could go wrong as opposed to a conventional loan. So if you can qualify for conventional financing, that's what we're going to try to do, and certainly give you the option. We'll make comparisons for you between conventional and FHA. Conventional will have lower down payments actually than FHA. They'll go as low as 3% down in certain circumstances. 5% down is really the most common. It's really the only type of loan where you can put a certain amount down and avoid this stuff called mortgage insurance. So mortgage insurance exists to allow you to buy a house with less than 20% down. Okay. At 20% down or more, you don't have to pay mortgage insurance. But if you don't have the 20% down, that's where the benefit of mortgage insurance comes in. So you pay a monthly fee or sometimes a single premium fee for mortgage insurance, and that allows you to buy a home. If you are looking for an investment property or a second vacation home, that's always going to be conventional financing. FHA, VA, USDA, none of those allow for that. So conventional financing has some significant benefits that way. Conventional does have a program that is designed around low to moderate income borrowers called Fannie Mae Home Ready and Freddie Mac Home Possible. I'll put some links in the description below to describe those products a little bit more. Those are important in today's world because the interest rates are lower, especially for borrowers with a credit score less than 780. So the new rules from Fannie Mae and Freddie Mac will add penalties to borrowers that have credit scores less than 780 with their Home Ready and Home Possible products. Those do not matter. Also with those, well, I shouldn't say they don't matter, but they have a much lower impact. Home Ready and Home Possible will also have the benefit of lower mortgage insurance costs. Now, if you go above 726,200 in the Twin Cities area market, then it's called jumbo financing, or otherwise known as non-conforming loans. And sometimes those interest rates are going to be very different from conventional loans through Fannie Mae and Freddie Mac. Historically, have often been more expensive. Sometimes they're less expensive. We'll be sure to compare those. So in summary, conventional conforming mortgage loans are a great option for borrowers who have got great credit, low debt to income ratio, and a sizable down payment. These loans conform to the loan limits of Fannie Mae and Freddie Mac. And if you are in the market for a home loan, we want to talk about all types of financing, but conventional loans will certainly be part of the discussion.
House, we will get you home. We will get you home.
I want to buy a house, please get me home.
We will get you home at last. We will get you home.